Hello and welcome back to this YouTube channel. In case you're just joining this YouTube channel for the first time, my name is Miracle Naji. I started my career as a management consultant and I currently work as an investment professional within the venture capital space. In my previous video on different sources of funding to startups, I had mentioned that different investors will have a preferred stage in the growth of the company where they would want to participate in investment in that particular startup. So in this video, I'm going to be breaking down all the different stages. I'm going to be taking you through all the different stages in the startup financing journey and helping you understand what is critical for each investor at each stage and the type of investors that tend to participate at that round. So without any further ado, let's get started. One unique thing about startups is that they are going to be needing tons and tons of cash in order to grow and succeed. But most times, this funding do not come at once because the startup has not yet reached that stage of maturity to require that amount of funding. So for that reason, the startup fundraising round is divided across different stages, each of them tied to different milestones that the startup is expected to see before moving to the next fundraising round. So typically we can divide them across pre-seed, seed, series A, series B, series C, and series D, and so on and so forth. We can also have startup raising a series E, series F, but as from series C upwards is usually categorized as late stage fundraising round. So the first one we are going to be looking at is the pre-seed round. So the pre-seed round is usually at that phase whereby in terms of what is the unique characteristics of the startup at that time, it's usually provided to the startup for product development and trying to find the product market fit. What do I mean? At the pre-seed round, the startup perhaps will be at the concept stage. They do not have a product yet. So the pre-seed funding is given to the startup in order to build out a minimum viable product and perhaps conduct a pilot test just to gauge how the product is going to be received in the market. So that's typically what characterizes a startup at the pre-seed round. So that means that the use of funds for a startup at the pre-seed round is to build a minimum viable product, hire their initial team members, and also conduct some sort of market research. And one thing we also see is that at this pre-seed round, most startups either try to bootstrap or raise funding from family and friends, or many times angel investors, like I mentioned in my previous video, are more open to participate in investing in the startup at this particular round. In terms of the average ticket size that you find for pre-seed round is anywhere between $10,000 to $100,000. But again, it's not cast in stone. It all depends on the startup and it all depends on the geography where the startup is raising its funding and also the prevailing macroeconomic conditions at that particular time. And in terms of the valuation of the startup, we usually find the startup being valued at anywhere less than $1 million. But this as well is not cast in stone. It all depends on some other factors, like I mentioned. Now, after the startup has been able to achieve the critical milestones in pre-seed, like launching a minimum viable product and also finding a product to market with, the next fundraising round is the seed round. So the seed round is usually for them to build out their product more and try to test out their business model to find a scalable business model that can be scaled across different markets. So at the seed round, it is expected that the startup will start seeing some sort of traction that validates the fact that they have achieved product to market fit. Now, in terms of the use of funds at the seed round, it's usually for product development, hiring more staff, more market research, and testing out their products more. When it comes to the seed round, at this particular point, we start seeing some venture capital firms paying attention to the startup, especially if the startup has achieved product to market fit and has started seeing some traction in terms of revenue. Then for average amount raised, they have typically have the amount raised from being from $50,000 to $2 million. Again, this all depends on the startup, the industry, and the prevailing macroeconomic conditions at that particular time. For valuation, the valuation of a startup at a seed round will typically range anywhere from $1 million to $5 million. This also depends on the sort of traction that the startup has been able to see within the period. and the milestones they have been able to see. So just as a rule of thumb, the more traction that a startup will be able to see, it gives the investor more confidence. It gives the investor more confidence in the value of that startup, and they will want to price the startup at a very high price. Then after the seed round, like I mentioned, the critical milestone for the seed round is that you're able to find a business model that can be scaled, and then you're able to build out your product more. Then we now move to the next round, which is usually called the growth stage round. So the growth stage, so pre-seed and seed are usually early stage, but the growth stage now is Series A. So at Series A round, the critical characteristics at the Series A round is that the startup has started doing high revenue growth, most times at double digits, because they have seen product to market fit, they have seen product to market fit, they have seen a scalable business model, so they are growing at a very fast pace, moving into new markets, hiring new staff, acquiring more customers. So that's typically what characterizes a startup at at the growth phase. Now for the use of fund, the use of fund is usually for marketing, team expansion, new product, including new product features. So for instance, maybe let's say for instance a fintech startup that is just into payment. At the Series A round, they could have other integrations that improves the value proposition to the customer. Now, in terms of the average amount raised at Series A round, we can range from $500,000 to $20 million. Again, this also depends on the startup, the traction the startup has been able to build, what the startup will need, what in terms of funding to get to their next milestone, and again the prevailing macroeconomic conditions at that particular point in time. During in 2021, where the macroeconomic conditions were favorable, we saw startups raising tons and tons of millions for their Series A round. But that wasn't the case in 2022 and 2023, when funding available to startup investing started declining. The last part is now the valuation. The valuation is around $10 million to $50 million. But again, this would also depend on the different factors like the macroeconomic conditions and the traction that the startup has been able to see. We can have startups valued at more than that. Some startups are even turned to unicorns at their Series A round. Then the next one is the Series B, and Series A, Series B are still also growth stage. For Series B round, the characteristics is that the startup is still seeing more revenue expansion, and sometimes they have started moving into new territories. So for instance, instead of just serving the Nigerian market, they are now moving into Ghana, moving into Europe or other Western markets. So that's typically what you find for Series B startup. They are expanding into new markets and also sometimes expanding their product lines. Then for the use of funds for Series B round, which is growth stage, is that they use it to build new products, achieve more growth, sometimes acquire new businesses. So instead of trying to build a product from scratch, they can acquire another startup to to engineer that growth. Also, it's typical for you to find Series B funding being raised to settle early stage investors that invested into the business, to provide them some secondary liquidities. In another video, I'm going to be talking about secondary exits. Then in terms of the funding raised in Series B round, can range anywhere from $2 million to $50 million, but this can be more or less than that. It all depends on the industry and the prevailing macroeconomic conditions at that time. And the valuation can be anywhere from $50 million to around $200 million. And it's not unusual to find a startup that is at the Series B round but valued at $1 billion. That is a unicorn. So there are nuances to these things. Then when we start moving to the Series C, Series D, Series E, Series F, and so forth, we are now talking about late stage companies. So for late stage companies, the focus of their funding is usually more geographic expansion and funding new acquisitions of new business lines just to continue to engineer growth, right? And also the use of funds will be around acquiring new businesses, hiring more staff, establishing their presence in new geographies, and then providing liquidity to early investors. The typical funding, the average funding range at Series C ranges from $10 million to around $100 million. But again, this would vary based on prevailing macroeconomic conditions. And in terms of valuation, we see valuations from around $50 million, $200 million, $500 million. Same applies to Series D, that is more expansion, more expansion. So we see acquisitions in terms of their use of funds is to acquire new business lines, hiring, establishing presence in new geographies. So there is a thin line between what typically goes on for Series B, Series A, and so forth, that is known as a late stage company. For the average amount range 20 million to $250 million, and valuation could be anywhere from $50 million to $1 billion. So if we are to group it, we say that pre-seed and seed is the early stage, Series A and Series B is the growth stage, and Series C and Series D and so forth will be the late stage. And what we tend to find is that different investors tend to participate at different stages. So whilst let's say you find more family and friends and angel investing in the early stage round, venture capital firms tend to come in more at the growth stage round. And then we also have venture capital firms that are set up to invest into late stage companies. So you see a venture capital firm having several funds, one fund for early stage investment, another fund for growth stage investment, another fund for late stage investment. And there's this sort of interrelationship between them, such that the early stage fund serves as a feeder to the late stage fund. Also, we see um, private equity firms now focusing more on investing in late stage companies, because late stage companies are more stabilized, they have going cash flow, they have validated their business model, and they can be able to see traction, and not the risk involved in investing in them are quite minimal. So in wrapping it up, I've been able to break down the different stages in the startup fundraising journey, from the early stage to the growth stage to the late stage. And the early stage typically pre-seed and seed, and then for the growth stage, Series A, Series B, and the late stage, Series C and Series D. In another video, I'm going to be sharing more insight about the venture capital ecosystem and what you need to know as a founder. Thank you very much.